Hey everyone, it is time for what I know is your favorite day of the week. We're going to talk about taxes because it is Tax Talk Tuesday. So if you watched last week's video, you know that we started talking about something called a 1031 or a like-kind exchange. Basically, a 1031 or a like-kind exchange allows you to defer capital gains that have built up in real property by swapping that real property for more real property. So if you are listening to this video and you have no idea what a 1031 or a like-kind exchange is, I encourage you to go back to last week's video. It gives what I hope is a pretty good primer on how 1031 exchanges work. But in that video, I teased that new regulations came out late last year, and additional guidance continues to come out dealing with what is real property for purposes of a 1031 exchange. Now you may be hearing that and you might be thinking, I have a pretty good idea of what real property is. Why on earth does there need to be a definition for it? Well, as with so many other things under the law, real property can be kind of a gray statement. So there's a lot of things that can collapse into the category of real property. And the IRS has decided to clarify what is going to be in that bucket and what's not going to qualify as real property. In other words, what will qualify for deferring capital gains taxes and what won't. So the new regulations give us a definition that says that real property is land, improvements to land, unsevered natural products of land, and water and airspace superadjacent to land. Now, some of those are exactly what you would think. Land, obviously, is the real property that you can physically see. And then the common definition of real property is usually going to include, unless you have a deed that says otherwise, that when you buy a piece of property, you are buying the land that you can't see underneath the ground. And you're also buying the airspace above that piece of property. Now, if you live in a big city, sometimes those things can change. So land and the water and airspace, that's pretty commonly included in the definition of real property. And so is the unsevered natural products of land. Those are things like timber on a timber farm, as long as it hasn't been harvested or it's not getting ready to be harvested. That's going to qualify for this 1031 exchange as well. So if you're buying property and included in that price is the rights to timber, that's going to qualify here too. But where things get a little bit more gray is going to be the improvements to land. So that second category I mentioned in the definition, the new regulations tell us that improvements to land are inherently permanent structures, and the structural components of those inherently permanent structures. So basically what the regulations have said, and this is meant to clarify what counts as real property and what doesn't, is that if there are assets that work together to serve a building, for example, they serve an inherently permanent structure. So things like the electrical system of a building, the heating and air system, the water lines, those sorts of things, those get analyzed together as a part and piece of the real property, and they may qualify as a structural component of that real property. To help with, I guess, differentiating between what's going to count as a inherently permanent structure and what's not, the regulations gave the example of a gas line. So if a gas line is running into a building and it serves the heating and air system, that's usually going to be analyzed together and it's going to count as real property for purposes of a 1031 exchange. But if that same gas line is coming into a building and it's not serving a heating and air system, let's say it's just serving an oven, an appliance, the IRS has said that gas line, when it's coming into a building that only services or only goes directly to an appliance, that's going to be personal property for Section 1031 purposes. In other words, you've got to itemize that on the filings that go along with this 1031 exchange, and the value of that gas line and that appliance are not going to count. They're going to count as personal property that do not allow the deferral of capital gains. So that, those are, it creates more work. So the 1031 exchange process becomes a lot more itemized, but at least we have some clarification there that if it's an inherently permanent structure or it's a part that services an inherently permanent structure, that's going to be real property for 1031 purposes. If it is just going to an appliance, if there is a piece of property that is not servicing what they call an inherently permanent structure, that's not going to qualify as real property. So that's improvements to land. There are also other assets out there that sometimes we have a hard time grouping with real property. These are going to be things like intangible assets. And so the regulations did do a lot for us in terms of clarifying what intangibles are going to qualify as real property as well. The regulations do specifically include leasehold interest, so a lease on real property, options in real property, easements in real property, and certain land development rights. All of those things in some way, shape, or form are going to qualify as real property. But it's important to note here that the regulations do basically put a durational test on this as well. And I won't go into a lot of detail here, but for things like easements or leases or leasehold interest, the longer the duration, the more likely it is that this is going to qualify, that your interest is going to qualify as real property for 1031 purposes. Shorter interest, a 3-year lease or an easement that is a temporary easement of some kind, it is more likely that those will not qualify as real property that you can swap under this 1031 exchange. Now there was hope that there would be additional clarification here, but that's about as far as the IRS and the Treasury decided to go. It basically said that shorter interest in intangible assets may not be real property, longer interest might be. And so it really becomes more of a facts and circumstances style test, and one that, quite frankly, you have to make an argument for. And kind of as a closing point here, when we're talking about what qualifies as real property, the IRS, the Treasury Department, they basically gave us one more category of real property, and that is anything that qualifies as real property under state or local law. Basically here, and I don't have a great example of this right off, but basically the goal was to make sure that anything that qualified as real property that didn't directly contradict part of this new definition was to make sure that it's still included as real property after these regulations come out. So overall, we could say that these new regulations do a lot to clarify what counts as real property and what doesn't. It purposely left some things gray, which can be a good thing. It gives us room to make an argument. But if you have specific questions about this, our office does not do real estate closings, but we know a lot of people who do. But what we can do is we can talk about the 1031 exchange process and kind of gear someone up to start that process. So if you do have questions, we're always happy to talk through those. Lots of gray, I think, is going to be the end result here. But as always, guys, we really do appreciate you taking the time to check these videos out. If you have those questions, feel free to reach out, leave a comment. But until next time, I do hope that you all have a great rest of your week. Thank you.